Hey guys, my name is Nell. Welcome back to another video in the series Forex Beginner Series. So today I want to bring you guys another video, and this one's gonna be super important. A lot of people have been asking me for this one, so here we go. Let's do this. So the topic for today is gonna be risk management. How to risk manage your trades so you're profitable every week, or at least from even winning 50% of your trades, you can still be profitable. How is that possible? How is it possible to be profitable every week, even if you're not winning every trade? So let me explain this to you guys. What if you can take small losses for every loss you take and a big loss that covers 2-3 losses every time you win? So what I mean by this is, let's say you're trading and there's a trade you want to take and you're willing to lose. So a loss would be $20 and then a win would be $100. So I will explain more about this on the charts, but for now I'm just gonna explain it like this. So imagine for every trade you took, I'm just gonna write everything out so it's easier to see. Every trade you take. So let's say now you want one trade and then lost. I'm gonna do 1, 2. I'm gonna make these reds just so I can show you guys that it's a loss. So now you guys won one trade and lost 2. I'm just gonna make purple as wins, reds as losses. I'm gonna make it green just so you guys can see. So what would happen in this scenario? So you'd win $100. So it'd be 100 minus 20. It's like we're going back to subtractions in elementary school. And then minus another 20. So in total, you only took losses of $40, and now you're back at a win of $60 for that week. That is still profitable, but you lost more losses than you want, than the amount of trades you won. How is this possible? Risk management. That's how it's possible. Forex makes it possible. So what risk management means is that for every trade you take, you're willing to lose a certain amount of money, but that certain amount of money is a small percentage of your account. So let's get on to this. So now we see a trade right here. Let's go back to a real life example. If I see a trade right here, there's an uptrend going up, it bounced off, there's a double bottom. So as you can see, it has bounced off the support right here, then it formed a lower low and then starts to reverse to the upside, as you can see, and starts to reverse higher highs, higher lows, and now it's just going upwards, as you can see quite clearly up this line. So what are we waiting for, and what do we look at for the trade? So I'm gonna let this trade play out. I want it to, as you guys remember, I want it to break out and form as a new resistance so I can enter my trade. So it's playing out. There you go. It broke through. It broke through right here. So what I'm looking for now is, where's the old support? Where's the old resistance? So there was a support and resistance, as you can see on this line 109. This is why I made these lines. If you don't know what these lines are right here, go back one video in the series and you'll see it. I'm uploading it right before this one, so it will be a lot easier to understand this. Use these lines, they're very important. So as you can see, this 109, there's a lot of confliction right here trying to pass through. It has been rejecting it multiple times. So what I'm waiting for is for it to break out and retest as a new resistance. So we want this. I'm going to form as new resistance. Perfect. So we want this to form as new resistance. So now let's see. So as you can see, now we got to this, and it broke out and has started to retest this as a line. Even if it breaks through a little bit, that doesn't matter as much. These are not going to be 100%. Forex is never on the chart. It's going to be perfect to how you remember the strategy to be, or how you learned it. So you got to adjust to it. So as you can see, now we're having it form right here. And at about the time when it starts to reverse like this, I saw this candlestick. I'm like, it's going to start to reverse soon. It has formed multiple lows now. So let's go to here. It won. You can draw these arrow lines, they help a lot. Arrows, I mean. So as you can see now, this has been on a downtrend right here. You could just draw these out. These are an easy way to tell. So what I would do is I would say, okay, now I want to enter at the bottom of this line. I'm ready to enter. So let's see what are the buttons that we're going to use to enter. So you're going to go over here, and whether you're going to be entering a buy, so upwards is a buy, a sell is downwards. I'm betting on it to keep going down, and what I would do is press short position. So long is upwards, short is downwards. So what I would do is I'll click right here, and I click where I entered the trade. So I would enter the trade around this area. So if I would be on the 1 hour, yeah, about this area. And basically, now let me explain what these green and red rectangles are, because these can be really confusing for a lot of people, especially at the beginning of trading. So the red box this is your stop loss. So whenever it goes into this line, into this rectangle, on the app you're trading with, or if this is a real trade, you're going to start to see red, and it's negative. But that doesn't need to scare you. The reason why it shouldn't scare you is because you don't have to be watching your trade all the time. You see at the top of this red rectangle, there is a red bar right here that says whatever this number is, and it obviously changes whenever I move it. So basically what this means is this is called a stop loss. In the Forex market or in the trader's world, this is called a stop loss. And basically what a stop loss is you're willing to lose this is called pips. I'm gonna explain this really soon, so for now just stick with me. You're willing to lose 40 pips in order to win, let's say, 99 pips, 100 pips. Now, just for now, for this explanation only, consider this as $40 and $100. They'll make it way easier than explaining everything about pips right now, and I'll explain pips in a bit. So basically what I'm looking for is I want to look for an old resistance or an old support where I don't think it will go through. It's a likely chance that it probably won't go through. As you can see, I see a resistance right over here. And if I draw it out with like a rectangle, I can take this as a resistance and use that. So as you can see, this is an old resistance that most likely it won't push through. So what I would do with the stop loss is at the top of the stop loss, this is the number you would enter on your phone as your stop loss. And what this means is if it goes and somehow starts to push back up and goes the wrong way, so if it goes from here and you just predicted wrong, it would close you out in the trade with just this, and if it keeps going, you wouldn't lose more. So that's what a stop loss is. If you don't put stop loss on your trade, it could be risky and you could lose more than you want to. Always gonna be confusing at the start where to put your stop loss and everything, but don't worry, it comes with practice. It's gonna hit your stop loss a couple times at the beginning. You might not be losing trades, but because it hits your stop loss and then goes the way you want it to, you don't win that trade, you don't make any money, you actually lose in that case. So I would really suggest just practicing it. Don't be stressed out if it doesn't work at the beginning. It's a little confusing to the beginning. That is Forex. It's all a learning process. So what I would do is I would place it a bit higher up over these lines, just so it just has the clearing room. I don't think it will come back up there. So that's the way to actually look for where to put your stop loss. Find somewhere where it had two bounces off on the same place. If it's this, if not, another thing I would suggest is if you're entering exactly on the 0.0s or the 0.5s, I really suggest going 1 over, so 0.6. So right here I'm doing 109.6. As you can see right over here, I'm going 109.6, 60 pips, so $60. This is the way I trade most of the time. This is the way I like to. It's safe because even if it comes up a little bit over here, the chances of it going past this, which is another support or another resistance, is very, very unlikely. So I like to put it a bit over. Or if I can see that it's bounced off this line multiple times, off this resistance, I can be a lot more safe with that too. So for risk management, I'm willing to risk $35. And now let's look at where we'd want to put our take profit. So this is a take profit. So when it hits this line, like the same thing I explained with the red thing, in this case, it would actually be in green. So this is the way you'd win a trade. So if it hits this, you take all the profits from there. Putting no take profit is something some people do, but I highly suggest entering a take profit because it'll help you get more precise in the markets and see exactly where stuff touches. So right here, as you can see, there's a support right here at this level that has been touched multiple times. And from like daily candles and everything, just from the way I look at this, setup, it looks like it's gonna revert and touch this again. So what I would do is just leave my take profit right there. So I'll leave my take profit right over here. So this means I'm willing to risk $35. So let's say willing to risk $35 to win 200. Does this make sense? So basically it's $35 and $200. This is the way I find risk management to work the best. So even if you're losing trades, even by one win, you can cover more than like 5-6 trades, like over 5-6 trades. Even if they're like bad trades, you can cover a lot of trades up with that profit. So I would really suggest to do this, and slowly over months, you're going to become more consistent to the point where you barely even lose at that point. And that's just a way to practice in your brain. And basically what the risk to reward ratio is right over here. It says 5.69. What does this mean? This is a percentage that the 35 pips, these are actually considered pips. I want to stop using the words dollars for this, because this is 35 pips and this is 200 pips. I'm just referring to it as this. So this is something I would do. And now let's just play it out. Let's see what happens. As you can see, now we're just in profit. We're sitting in profit currently. And it comes back up. The thing with this is I'm glad that we kept our stop loss, because now we're just chilling and we just wait for the trade to play out. Now we don't have to worry about anything. This is the time when you can go away from your computer and just do whatever you want, go out with the rest of the day. That's what I love about trading, the fact that you don't have to sit at your computer all day. As you can see, he touches it multiple times, as you can see, and then finally starts to shoot down. I'm just going to extend this just so you guys can see it play out. And this is basically how it would look as a winning trade, like a profitable trade. At the beginning, don't expect to see this every trade you do. Don't expect to see it even more than 50% of the trades you do. At the beginning, it's just learning. And then you'll start to profit over time. It takes a lot of time to learn, but it's so worth it, because the money you can make in Forex is not even comparable to anything else. So there you go. Just gonna wait. So I put these numbers 107 into my chart, and there you go. We just won that trade with the 200 pips. So let's explain what 200 pips is and what pips really mean. So let's explain to you guys what pips are. So pips for short means pips in percentage, which it's just a percentage of how much the market has moved. And with that, it's calculated by the lot size, which would equal how much profit or loss you would get. It sounds a little confusing now, but once I show it to you guys and write everything out, it'll be a little easier. So when you're entering your first trade, at the top of the MetaTrader app on your phone that you enter your trades from, it will ask you for the trade you're going to take, what is the lot size you're going to pick. And at the beginning, I didn't understand what this meant. And I'm guessing for you as a new trader, you probably don't either. So let me explain it to you the way I learned it. So the way I learned it is I learned it to measure the lot size out with how much your account balance is. And what I mean by this is, so let's say you have a $100 balance. And for this $100 balance, what would the lot size be? So let me explain this to you. So for every $100 in your balance, you would put 0.01 as the lot size. So if it would be 200, you would go for the $200 balance, you would do the same thing but 0.02, and it'll just keep going up. So $1,000 is 0.1. So I'm just gonna draw all these out so you guys can see them. So here we go. And basically what I want to show here is for your lot size, for every $100 balance, every $100 you have in your balance, you would be putting a 0.01. So at $1,000, you'd be 0.1. Now, what does 0.01 mean? So for 0.01, it is actually measured to how much profit it is for every pip. So for every pip, it moves. So we had a 35 pip loss and then a 200 pip profit. So what this means is for the 0.01, it would be 10 cents per pip. So it would be 10 cents per pip. And it would keep going up. Obviously, it multiplies to 20 cents per pip here. So it would be 20 cents per pip, and it would keep going up till 1,000, and then at 1,000 it would be $1 per pip. So this is when like trading starts to get really fun, because your profits now can really buy you start to buy you stuff you want and start to like it starts to motivate you because now you actually see the profit. You could even start paying off rent if you want to pay for a car or something like that. This is when profit starts to become really fun. So it'd be $1 per pip. So for the 35 pip loss for that trade and that 200 pip win, for everything you can see how much every pip would be. So this would be $3.50 for the loss. So it would only be 3.5% of the $100, and that would be a 20% win. You don't have to always go for that 200 pips. You can go for 100, 150. You could pick whatever works. You adjust it. Your profit should never be like a stable 150 every single time, because it won't always hit 150 pips. You just have to predict it from seeing where it's going to hit in the market. But basically, this is how you measure it out. And my rule of thumb for trading is no matter what, don't risk more than 6% per trade. I say 6 because I do a lot of 60 pip trades. And basically that's 6% of my account. And this way, no matter what, you're going to be profiting over 10% every single win and losing less than 6 or less percent every single loss. So this way you're going to be profitable every week. This is how I found to be profitable every single week. Well, it won't be profitable every single week at the start for when you're learning how to trade, but I'm saying this is something that once you get consistent, you could be making every single week, because you can, as a trader, once you get more experience and you start putting in like you've already had years of experience, you start to get consistent to the point where you win more than 50% of your trades. And once you're winning more than 50% of your trades, then no matter what, you're profiting every single week, which is amazing. So this is the way you can be in a risky market, but risk manage and actually profit more than you risk, which this is like the way I found to be profitable every single week. I hope you guys learned something new. I hope you guys enjoyed. Don't forget to subscribe and keep watching the content. See you guys in the next one.